What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on our broad market. We've got our core list of companies that we're always watching, and I would point out that we have gone ahead and replaced Alibaba with AMD. The options on AMD are fantastic, plenty of liquidity there, no issues. We will, however, reevaluate once the Google split happens and see what those options and liquidity in those options look like. So we'll see, but for now, AMD will stand, and then after that we do have 3 additional trade ideas to share with you towards the end of the video, so definitely stay tuned for that. As always, anything we are associated with is linked down below in the description, and without further ado, let's jump right into these charts. Kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure, there's no doubt about it, the bears take home the win on this front this week. You can clearly see very little upper wick, indicating that the selling pressure was fairly constant throughout the course of the week. A little bit of a lower wick, indicating some buying pressure, but overwhelmingly it closed much closer to the lows as opposed to up towards the highs. That goes without saying. So bears take the structural win. From a location standpoint, we also have a weekly lower high and a weekly lower low. However, we are still above our February 24th invasion panic low, if you will, from what was that, 3 weeks ago now. So that is still intact. However, if we think about pattern and tie that in with location, and we do something like this just to remind ourselves of the head and shoulders pattern, we have now closed the first weekly bar underneath the neckline of that pattern, which is, of course, a more bearish indication. So from the weekly perspective, we should expect lower here based on everything we've discussed, but this low from February 24th will prove to be a major hangup before we can just say, okay, it's clearly a move lower at this point in time. If that is breached, okay, so the February 24th low, then I would start to target this area right around here, 404 roughly on the weekly time frame. That's what we have to the downside. I would also point out, as we're looking at this longer time frame chart, that on Wednesday of this upcoming week, there is going to be a lot of economic news coming out around 2 p.m. Please be prepared for some volatility. We're expecting a 0.25 interest rate increase. The Fed funds rate is coming out. That's the expectation. Everyone is sort of the belief that the market has already priced this in. So if we get 0.25, which is the expectation, no one's really expecting any surprises, especially given the overseas tensions. I think things shake out. Sure, there might be some volatility, but we won't see anything wild. If we happen to see less than 0.25 and they throw us for a loop, they give us the donut hole here, no increase, the market may respond favorably to that and make a move higher. However, it may not be the best decision for the long-term health of the economy. And yes, I fully understand that the economy and the market are two separate things, but short-term pleasure, long-term pain in my estimation. And then clearly, if we get the surprise in the other direction, so 0.5, a double rate increase right off the bat, I do imagine that the market responds negatively to that type of situation. So again, everything's kind of going to be going down on Wednesday at 2 p.m. Be prepared for some serious market volatility. Let's move on down now to the daily time frame charts and start talking about levels that could be in play into this upcoming week. So the first thing I would point out is that we do have, from the sort of daily time frame chart, a lower high that has clearly been developed. We were sort of iffy about it on Wednesday. Things were looking like they may have wanted to recapture that 429. We were actually slated to be opening on a slight gap up there. It just didn't materialize, right? So to us, that's going to be nothing more than a lower high now from the daily time frame perspective. What's combating that, though, again, is that February 24th low from right in here, and the fact that on Tuesday, we also set a higher low. So we are technically in a new area of balance. You can see that for the past 4, maybe 5, I mean, you could consider the entire week's range an area of balance. It was 2 days down with some serious volatility on the Tuesday session, and then up, but gap down, and then up, and then down. I mean, we're stuck in a period of balance. You can see how this would mirror very closely what we had right here. Correct? So as the market just sits in balance here, I think for the longer term traders who tune into these videos, you need to be patient and wait for some sort of trend reversal. Sure, we are starting to get that higher low phenomenon here, but don't forget that we do have lower highs. So you could start to call this a compression of range. And once this breaks one way or another, you can start to have more conviction in the market in terms of a directional move. As of right now, it's been extremely choppy. That's sort of the market sentiment out there, right? Everyone complains about how choppy this market market is, it's because we're getting this range compression, right? So that's what I'm seeing. The larger moves are going to develop either under or over the resistance or support trend lines. In terms of what we can watch out for short-term intraday trading, this is still your upside pivot, obviously the top of the range, that's 429. If that cracks, look at your resistance trend line and potentially this level right here at 437, right? It was the low from here. Remember, then it acts as resistance for the top of that range. That's your upside target. If we get a positive break, let's say things go positively on Wednesday, that could potentially be the upper target. If things go horribly on Wednesday, then obviously February 24th low, the invasion panic day low, is on your radar at 410.65. And we've mentioned from the weekly time frame that if that breaks, your target's going to start to come back down towards here, 404. Okay, so that's what we've got on our radar in the S&P 500. For now, it does look like we are remaining in a downtrend, right? You can clearly see lower highs are continuously developing. This is the only complicating factor. If that support trend line breaks, if this horizontal level breaks at 417.50, which remember also was the point of control from that Thursday panic day, then again, I do think it's at least lower into the lows, if not lower, closer to that 404 level that we've been pointing out. Before we move along, there's a couple of other things I want to point out with our S&P 500 specifically. Firstly, with the Fibonacci's on our price action here, if we come in from the top all the way to the bottom, notice that a majority of the past 2 weeks, basically all of the past 2 weeks, has been underneath your 38.2 in terms of consolidation and what we consider healthy pullbacks. This is nothing more than bear flag activity. Ultimately, over the course of time, if we keep failing at the 38.2, which to give you a number is that 437 level, then we should be looking for lower over the course of time. That paired with the weekly breakdown of the head and shoulders, it makes sense for bearish, right? While we're talking about the S&P, again, there's a couple of more things that I do want to point out with you guys. We're going to take a look quickly through our sectors. We'll go through all of them, right? So the XLU utilities, a defensive sector by nature. Why is it forming a bull flag? That certainly is not a risk-on signal for your marketplace. So XLU, not looking so good for upside continuation in the S&P 500. The XLF for financials, the second heaviest weighted sector that we're watching. You can clearly see, if we zoom back in for a second, that we are underneath still this shelf of lows. It looks like we may have recaptured it on the Wednesday session. It didn't happen. There was no hold of that level. Remember that we specifically pointed out it was an inverted hammer on the back test, and now we're back down underneath 36.85, another bearish indication for your S&P 500, indicating a failure to accept back within this overall range from here. Builders, not a huge portion of the S&P 500, caught in chop. XLV for healthcare, third heaviest weighted sector that we are particularly watching. Here you go. Where are we? We're at the midpoint of the range. Does your edge exist at the midpoint of the range? If you've been watching for the channel for any period of time, you know the answer to that question is no, absolutely not. We're either waiting for a breakout or mean reversion from the top, and the same is true but opposite from the bottom, mean reversion or some sort of breakdown. So this is not really helping the case for a bullish S&P or a bearish S&P 500, right? So XLV fairly neutral, midpoint of the range. Continuing along, XLI for industrials, nothing really too impressive happening here. Lower highs continuing. Again, if you were to draw this as kind of a range, right at the midpoint. So again, this is not helping one direction or another. We know that energy has been off the charts. That's clearly continuing to hold up here at these highs. I would say that this chart is bullish. Energy as well is more of a defensive sector by nature. So it's not really a good thing to see this at the highs if you want your market to have some sort of turnaround. Real estate up next. What do we have here? Just sort of stuck going sideways as well. Not too impressive of a week. However, I can start to see the possibility for some sort of inverted head and shoulders happening here if we get a break of that resistance trend line. Remember that the real estate sector also is more defensive in nature. So would that be a good thing for the S&P 500? Not entirely, right? Not entirely. Sure, it could help, push prices slightly higher, but it's not happening in the right sectors, right? We of course want to see those heavy aggressive sectors making the move, not the more defensive ones. Staples, again, another defensive asset class. This one actually falling off a little bit, which is, I don't want to say a good thing for the S&P 500, but in terms of combating inflation, right? This is one of those sectors that you would kind of keep tabs on. It's nice to see it coming back down a little bit, right? We were sort of monitoring this resistance trend line for a break. It didn't happen. So again, that may be more of a neutral to slightly positive thing for the inflation situation, at least in the S&P 500, and monitoring how these sectors interact, right? We know that this is more of a defensive sector for taking advantage of higher interest rate environments, right? Everyone's going to need food, clothing, those staple items, hence the name consumer staples, right? So XLK up next. What do we have in the tech sector? This is the heaviest weighted sector of the S&P 500 en masse. And what do we have, right? You can clearly see lower highs, lower highs, lower highs, equal lows, right? So this is a difference from what we saw in the S&P 500 as a whole. Instead of having the higher low on the Tuesday session from this week, we have an equal low after a lower high. To me, a third attempt here in short proximity of time sets that up as a flush point. We would look for lower after that, which would be a huge drag, the biggest drag on your S&P 500. So please keep an eye on 142 in your XLK. If there's some sort of rebound, you want to see it above that high right here for potentially either compression of range or the start of a potential reversal, right? There's really nothing major going on until we can crack that double bottom neckline, which is 154.60. So that's XLK in a nutshell, the most important sector to pay attention to. XLC for communications, a fairly heavy weight in the S&P 500. And again, look at the chart here. You can clearly see a lot of weakness, big lower highs, equal lows. That's a bearish pattern. We're firmly in a downtrend. We're looking for that next lower low in communications. And obviously, yes, this too will provide some serious drag on your S&P 500. And then the XLY for consumer discretionary, another heavier weighted sector, more of your aggressive risk on type sector. This also is looking fairly bearish, right? You can clearly see your lower highs that are developing, your equal lows down here. If this cracks sort of the 3-day balance that it's stuck in, we would expect at least the equal low. And obviously, that's more drag for your S&P 500. Look at the bearish engulfing day that printed on Friday's session, right? That's really not a positive sign. Essentially, we've undone 2 days of consolidation or an attempt to hold from the buyers in one single fell swoop session. So we would expect lower after a day just like that. So hopefully by going through these sectors, you've gotten the sense that most of them are poised in a bearish position, even the ones that are more neutral, like our heavier weighted XLV for healthcare. This isn't really going to hold a candlestick to all of the bearish patterns that we've been seeing so far. And also, I mean, don't get me wrong, we do still have here the lower highs that are forming. The equal and then much higher low is the only thing that's keeping this trend slightly more neutral, okay? So that's the XLV. And then lastly, for our S&P 500, this is not something that I oftentimes bring up, but we're going to do it for the sake of today's video. This is the SPX A200R, and what that means is it's the percent of S&P 500 companies trading above their 200-day SMA, simple period moving average. That's this chart up on the top. Down below, we have a monthly of the SPY as a whole, the S&P 500. Now, unfortunately, this chart only goes back to the beginning of 2004. So I'm going to zoom in on our bottom chart from 2004 going forward. And what I want to point out, the reason I'm bringing this up is because the stocks in the S&P 500 itself that make up the S&P 500 are starting to come down into this very historical period where you can see as we bottom out multiple times around this area, right? This is historic. This is the 2008 crash. This is obviously the sickness lows from in recent times, right? Before that, and other than these two particular instances, look at where it's bottomed out prior. Right at this level, roughly 0.3, and we're rapidly approaching that level, if not already there. So I'm not saying that this has to be a bottom in the S&P 500. We've talked about a number of bearish things that are actually out there, but keep this in the back of your mind. The long-term investor in me that just stashes money away in the long-term portfolio is seeing this and saying, it might start to be the time where we start initiating new long positions in that long-term portfolio. You have to think, and if we just go back over and take a look at let's go to a weekly here, and we'll go out to a weekly. Oops, that's a monthly. We want a weekly. There we go. There's our weekly. We'll remove some of the moving averages. No need for any studies this week at all. There we go. All I want to do is take a quick measurement from the top. I'm going to do this so we can see the information box. Watch the information box there. If we go to the lows recently, we've so far seen about a 16. We're looking at Apple. I just realized. My apologies. It looks like the ticker did not stay on the SPY. Here's the SPY. Again, apologies for that little discrepancy. Anyways, same sort of deal, right? Look at the information box at the top as I hover my cursor here. We're looking at about a 14.5% decline from the all-time highs in the S&P 500. Now, on average, you get a pullback in the markets like this. So roughly 15% every 2.5 years. That's the statistical average. It doesn't literally have to happen that frequently, but that's the average, right? So if this is only going to be a gift that we get 2.5 years, right? Every 2.5 years, then again, for that longer term portfolio, maybe it's time to start taking advantage. Now, I'll also read you the statistic for a 20% correction. That's every 4 years, and a 30% correction every 9 years. And just to give you a rough idea of where 20% would be, that would be here closer to 383 in the S&P 500, and then the 30% correction, really nasty, taking us almost off the screen here. We're at 29, and then we're off. So it would probably be closer to 338, 337, give or take, in your S&P 500. And again, that only happens every 9 years for the 30%, every 4 years for the 20%. So I know this was a little bit unconventional for our broad market analysis. We don't oftentimes take a deep dive like we've just done, but that's what I'm thinking about. That's kind of where my head's at for this upcoming period of time. So here's the QQQ on the weekly time frame chart. A couple of major differences I want to point out here. Sure, we still have that bearish weekly candlestick, new lower high, lower low, right at, or much closer rather, to that February 24th invasion panic low. Notice an uptick in the selling volume as well. And if we think about a head and shoulders pattern, this one is well below the neckline right here. As a matter of fact, last week, we actually printed the inverted hammer, bearish candlestick, right, off of the backtest of the neckline. So there is relative weakness here in your QQQ, the NASDAQ 100. What do we have for levels underneath us to be paying attention to? We're kind of sitting on an important one from right in here. That's going to be roughly your 316, 315-ish mark. But if that breaks, our next major area of support is coming in at 305. Keep that on your radar for a major downside target if we see a poor reaction from what happens on Wednesday at 2 p.m. That's our weekly time frame chart. Let's go down to the daily, talk about tradable levels into this upcoming week. Zooming in on our chart here. And again, you can get the sense that we clearly have the lower high, something that we've repeatedly been bringing up in the Wednesday videos as well as on the live streams at times. Look at the back test of this range right here. The S&P 500 made it all the way there. The QQQ did not. So if you need relative weakness, if we're looking for shorts in the marketplace, look at the NASDAQ, look at your QQQ, look at your tech companies. If we need longs, I would opt for the stronger of the two, aka the S&P 500, right? So that's one little, it's not quite arbitrage, but you get the gist, right? You want to find the relative strength or the relative weakness and then comport yourself accordingly. So in this one, we don't cleanly have as much of a balance area as we do in the SPY. We have a bearish engulfer on Friday. To me, it looks very likely that we come in for the test of that 318.20, the panic invasion day low from February 24th. Of course, anything underneath, we talked about those weekly downside targets. 315 is a gap, right? We saw that basically right here. And then underneath that, there's your 309. We discussed that level as well. Everything about this chart would suggest more bearish activity given that we have that more significant lower high from here to here, relatively closer and equal lows. It just doesn't look nearly as bullish as, well, I don't want to say that the S&P is bullish first of all, but it doesn't look, there's just clearly relative weakness. I guess it's as simple as that. I don't need to make it any more complicated and try to reword it. So relative weakness, QQQ, it's as simple as that. We will come in with the Fibonacci's like we did in the S&Ps just from here to here. So the significant, sell-off period, not the true all-time high in the Qs, but nonetheless, you can see that for the past 2 weeks, or even 3, all of our activity is well below the 38.2, which is, of course, bearish consolidation. Over the course of time, we are looking for that to break down if we fail to take out the highs here at 348. Again, with the news and announcement coming out on Wednesday, I would be prepared for either possible direction. If we take out the highs, maybe it's long, but keep in mind you have resistance just overhead at 340, and then here, that's the major level. There's your 348, the 38.2 that we were just looking at. If it's lower, we already covered the downside targets. Let's wrap up our broad market. I know it's been a long one today, but there's a lot to be looking at out there in this current market conditions. IWM Russell 2000 in our small caps. Let's quickly go out to the weekly just to keep things congruent here. Clean chart. There we go. What do we have for weekly structure? You can clearly see more indecision, right, as opposed to a more bearish breakdown on this past week's worth of trade. You'll also get the sense that we are not clearly, or not nearly rather, as close to that February 24th low. So believe it or not, there is some relative strength inside of your small caps. However, don't forget the overall perspective that we are just forming a new balance area underneath this balance area from here. Think of all of these people as overhead supply. We've really failed a number of times at that 208 back test. You can see multiple weekly upper wicks there. It doesn't look fantastic, but just based on where we are relative to the lows, maybe there's some tiny little smidge of relative strength here in the Russell 2000 and our small caps. On down to the daily to talk about our tradable levels into the upcoming week. Play this one very mechanically. If we crack the 3-day balance lows here, which again, it does look like the market is leaning slightly more bearish than bullish as of right now, we're going to firstly target the week's lows that's here at 193.50, and if that cracks, then it's in play to the February low, correct? If we take out the highs, look and remember all of the overhead resistance pieces that we have here. It doesn't strike me that it's going to be an easy long, but do just keep in mind that our range compression is the cleanest here in the IWM with the higher lows like this, the lower highs like this. If one of these breaks, that's probably your heads up to say, okay, we're either coming to here, target that February low, or if we crack here, it's all about 208 really from that weekly perspective that we just saw. All right, so that's your IWM in a nutshell. That's the broad market in a nutshell. Hopefully you enjoyed that deeper dive that we did today. Let's get into our companies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. Kicking off our companies here with Apple, I would clearly point out the lower high that was formed on Wednesday and the fact that we also broke down underneath the Tuesday and Thursday support from those lower wicks, closing weak at the lows on Friday. I mean, clearly here, the sellers have the upper hand, right? So the main level we want to pay attention to is that invasion low, the February 24th infamous day low that we're paying attention to in almost everything that is still above that level, right? So that's your critical support underneath us at 152.20. If it breaks, 147.82 is the next level coming from our prior bull flag here. It was the low end of the flag, right? Which led to this significant rally. So that's what the number is and where it's coming from. To the upside, to start leaning on longs inside of Apple, I'm not feeling the love until we can break above this lower high, 162.50, also the low end of the prior balance right here, and then put in some sort of higher low, right? That would start to have me feeling a little bit more confident, but as of right now, again, not feeling the love from the buyers. Short-term sellers are definitely in control here. Let's continue along and talk about Netflix. What do we have on the docket here? Well, I would point out that we had this descending triangle, right? And Monday, or excuse me, that was Tuesday, we break down underneath, get back above the breakdown point, but roll back over after a clear lower high, right? So from here to here, lower high on the daily. Friday session closed weak at the lows, equal low 340. We're just looking for downtrend continuation at this point in time. We have a bearish pattern, bearish context. It makes sense for lower. To lean on longs in Netflix, I would want to see the same thing that we just discussed in Apple. Predominantly a recapture of the major low of the pattern, correct? That's going to be your 352.67. But more importantly, I want to see us above that last lower high here, which is 362.34, and then sort of higher low that then holds the bottom end of the pattern, right? So that's what I would want to see for longs. Doesn't look likely as of right now, but one step at a time. To the downside, if this 340 breaks, what's the target going to be underneath? Do we have anything? 307, let's see where that's coming from. Nothing on the daily. Let's quickly go out to a weekly. I want to make sure that we're not missing anything. We'll go to a 5-year just to make sure we can see it all clearly. And yeah, that's looking about right. You can see prior resistance, a little bit of chop, led to a bounce, and then held here on the retest. So I like 307 as the technical level below, but keep in mind, 340 to 307, quite a ways to fall if Netflix continues to exhibit bearish activity. Tesla up next, back on down to the daily time frame chart though. What do we have on the docket here? You can clearly see, again, resistance trendline in play, continuously producing lower highs. We have equal lows here, so a descending triangle in the short term is in play. We were monitoring this as relative strength, bull flag, right? If I do something like this from that February 24th low up to the high, at first, the consolidation was well above your 38.2. That strikes me as being bullish. Notice what happens on Monday. We break, but immediately recapture the next day. So, okay, fine. We'll chalk that up to a little bit of an anomaly. But what happens after that? Lower high is put in, and then we close on Friday underneath the 38.2. So that bull flag to me is no longer really in play. To the downside, on breaks of 800, and we know that's a historic level. Not only did it hold here for support, but it was the prior breakout point that's off the screen to the left. If that cracks, you're looking at 762. It's an intraday level from here. Let me just illustrate this on a 30-minute time frame. Let's grab the 30. There we go. And here we go. There's your 762. A little bit of chop around that. That's your first downside magnet. Anything underneath that, thin structure till we get to that February 24th invasion day at 700. A full 100 points underneath us here inside of Tesla. So please be careful. If this 800 starts to break, a larger move could potentially unfold in this name. To be bullish on Tesla, we know also that 854 has been a major pivot, right? We've been talking about this almost nonstop in all of the pre-market live streams because most days we had some interaction with that number. If that cracks back to the upside, upside, start to target this area here. There is a pressure cooker top, 3-day highs stacked at 886, but as of right now, does not look like the likely scenario. Continuing along and getting into our new candidate here, new kid on the block, we've got AMD. Now, I have traded this before. It's not like I've never seen the thing, but I'm not as familiar as I am with something like, let's say, Apple, okay? So it's going to take a little while for me to start to understand the personality of this as I would something like your Apple, but for now, just keeping things strictly to TA, well, we can clearly see we're underneath the February 24th low. We do have this to contend with, though. It's also very close to 100, the psychological number. We've got a week's worth of balance, right? So for me, it's kind of a patience play. Better trades to the long side are up and over the top end of the balance there, also the low end of the prior support at 112, we'll call it for round number's sake. The target would first be the resistance trend line coming from anchor, touch 1, touch 2, touch 3. Very, very well-respected trend line. I would expect some sort of interaction when and if we get there. And then anything after that, you're looking at 119. To the downside, obviously a breakdown of that 100 does strike me as a fairly bearish outcome, giving up a major area of support. You can see it with support here as well. Prior breakout point from here would be the next contender, roughly 95. So about $5 to the downside under that. And just like an Apple, from this bull flag right here, the low end of that support is 85.59. I'm not saying that's in play this week. I'm just sort of starting to map out AMD for videos going forward from here. So that's what we've got in a nutshell. Again, 5 days of balance, treat it exactly like that. We're kind of at the midpoint. I would be patient for a move to here and then get something like this or this. And the same is true, but opposite. I know I sound like a broken record at the bottom of the range there. Continuing along and talking about Facebook, what do we have? Very similar to your Netflix chart. However, it's more bearish, right? Because obviously, you can see that we are sort of right at that low. But more importantly, it's not like we had in the past stronger support around here as well. So more bearish, just in the sense that the trend is stronger. We're clearly putting in lower lows after a lower high here. There's no reason to think bullish unless we recapture that level and get a break of the resistance trend line. If that happens, maybe the target's here, but keep in mind also, you have the bottom end of balance to contend with at 202.50. So for now, leaning on shorts underneath this flush point here. Let's map that out so we have a number to pay attention to. We'll grab the other tool and put that in. That's going to be 180. Let's just call it 186, right? 186.11 is technically the low of Tuesday. If 186 breaks, we are looking for more downside inside of Facebook. And what do we have for supports underneath us? 174. That's the historic level that we've been talking about for quite some time. You can see it on the weekly. Again, if I grab more years, let's go with like a 5-year. There we go, right? So support, a little bit of chop through it in there. Not so important, but more importantly, those two interactions do strike me as noteworthy. So 174 is the downside level if we see continuation inside of Facebook. Back down to the daily and continuing along to NVIDIA. Oops, skipping around, getting wild with the mouse. Here we go. What do we have? Compression of range. This one happens to be the cleanest in my estimation, just because the resistance trend line is clearly very, very well respected in this name, right? Very, very well respected. And our support trend line is a long-term support trend line. You really only need 2 data points to draw the proper angle, but it is, just know that the anchor point is roughly further off to the left. So nonetheless, what do we have here? It's going to be a really important reaction in NVIDIA, whether or not it's a breakout or a breakdown from this compression of range. Based on everything that's kind of going on in the broad market right now, it's not poised in the best position here for there to be some sort of positive reaction. For now, I would keep a very close eye on this now triple bottom. That's roughly 209. If we come into it for another time, in short proximity of time, that would be a fourth touch after consecutive lower highs, lower highs, lower highs. That sets up a descending triangle instead of this more symmetrical type look that we have on the longer time frame. That's certainly a bearish pattern, and a breakdown of 209 easily takes us into 196, if not lower after that. We'll go out to a weekly in a second, but I do want to cover the upside first. That's your critical recapture area, 233.50. If it happens, start to eyeball that resistance trend line on the top of this prior balance at 244. If all of that clears, that's where the better range starts to unfold. I wouldn't pay too much attention to 257.50, but more importantly, the double top from right here, 266.25, right? So that's if there's some sort of thing that does this over the course of the week. If we get really positive news on Wednesday, maybe into next week, the move develops like that. But for now, again, the bears simply do have the upper hand, and be very mindful of that 209. Let's quickly go out to a weekly just to see what we have underneath us. And again, now you can clearly see that origin point there. So underneath this 196, which was prior support here, we have 179 even, okay? So downside break of this descending triangle here in NVIDIA, fairly nasty, right? Fairly nasty. So that's that one in a nutshell. Microsoft up next, back down to a daily. What do we have on the docket here? 3 clean days of balance, starting to poke underneath the lows there. We're just looking for a rotation. Notice that we've already tested the low of the February 24th date. If it's retested again, Obviously, bearish indication, right? Clearly lower highs coming into it, a breakdown of let's call it 281 just for round number's sake, which already is starting to unfold. Look for your equal low here. This 275 is not really the number anymore. It's kind of this level right here, 271.50s, we'll call it for round number's sake. That's your downside trade earlier on in the week. If it wants to reattempt the top end of the range, notice that we have 1, 2, 3 equal highs at the 289.50. If it breaks, all about the resistance trend line. But even if that happens, I'm not overly excited about longs until we can actually break that and get above the resistance trend line. Most importantly, also 300, right? We've talked about the importance of 300 Microsoft for quite some time now as well. Continuing along, last but not least, the beast, but not for too long, because we do know that there has been announced a 20-for-1 split inside of Amazon. So if you had one share, you'll now have 20 shares, and the price will be somewhere right around $200, sub $200 per share. So this will become much more accessible to many more people. The options market, I would imagine, does increase in terms of the total amount of volume and open interest that's there, which is a good thing for us as traders. More liquidity, easier, ins and outs, tighter spread. So with that being said, what's going on with the price action though? Clearly gapping higher on that news. Notice that Amazon though, it was already below and getting price acceptance underneath its February 24th low. That strikes me as a very bearish thing. Notice also that on the gap higher, we were not able to get into this range, and just like the rest of the market, this one just sort of played catch up, right? Many of the other things had bounced and were trading here anyways. Amazon, it was exhibiting relative weakness. Now it's just kind of on par with the bearishness of the rest of the market. So I'm not really seeing anything exciting here in Amazon to the upside. As a matter of fact, I would start to think about this gap fill as a potential trade into the upcoming week. Anything that breaks down underneath 28.79 fills the gap closer to 28.10, and then after that, it's just back down here, right? We know that we have a historic support around 2,700 roughly. If it's going to be upside, it's got to be a recapture of this 29.85, and then it's the resistance trend line as target. Again, I'm not overly excited about longs in Amazon until that can actually break. Even all of this has to break before I'm excited about Amazon longs. If I go out to a weekly, just to remind you of the prior chop range that we had, just like the IWM, look at the back test, right? Break and retest, really important level there at 31.76, currently well beneath it, okay? So that's what we've got in our core list of companies. Let's move along into these three trade ideas. Long video today, but we're moving right along. You hit the thumbs up button, the subscribe button, the bell button, all of the buttons YouTube tells us to tell you guys about, and let's get right into these ideas. Bank of America is up first. That's ticker BAC. You can clearly see that we are stuck in a 3-day balance area. However, we're starting to lean more on the bear side. Not only is our financial sector, so the XLF, bearish underneath that 36.85, but you can see that we're getting closer to the low end of the balance. We have upper wicks clearly rejecting the top end, these highs, also the highs from right here, rejecting the gap overhead. So to me, I'm looking for the breakdown to fill the gap underneath. That's 39.68, and then continuation into the 2-day lows here at 38.20. Now, 2-day lows like this oftentimes get some sort of repair, even if it's just a quick breakdown and then recapture. Look for that level to break, as there are probably many stop losses stacked right underneath that area. Look for a quick stop run and then reevaluate the chart if we get the downside play in the first place. Clearly, if it's a break of the 3-day highs, just look to trade for the gap fill. I wouldn't push your luck to the upside much more than that. So that's 41.43 up to 42.20. Not much range in Bank of America, but if you play it with options, there's enough to go around. Bumble is up next, and this one reminds me exactly like SQ from last week's video. Look at what we've got. We've got an earnings gap up. The broad market's weak. We've preceded this with a massive downtrend, and we're starting to break down into that gap. Just look for this to continue to fill, right? We also have an inverted hammer on the Thursday session, indicating that was like your advanced warning. Hey, sellers are waiting to take advantage of this opportunity, either to sell it at a higher price, or you have trapped longs from here looking to get out on any positive news that they potentially can. So looking for bearish continuation here inside of Bumble for the gap to continue to fill. Ultimately, as we continue underneath Friday's low, which is 21 even, we're looking for the rotation into 17.13. Short trade idea here. Not so interested if we recapture and then get acceptance above 22 for something that would look like this, right? That would sort of be a fake break into the gap, and then I wouldn't really look for that continuation. Instead, wait for a different setup. Whether or not it's a new range, then we can play the breakdown or the breakout, or some sort of pattern, right? Maybe it's some sort of pattern. We'll see. So Bumble looking for shorts though, as the chart currently sits, for the gap to fill underneath. Next up, Hertz. This one might be like, hey, this thing, dead and gone. Like, it was interesting while it squeezed way back. Well, what I like here is some relative strength, right? The only reason that this made the cut, and notice that our list is fairly small because I don't really think there are many setups that are extremely promising into this upcoming week, but this made the cut simply based on the relative strength here and the fact that it took out and closed above on Friday this interesting neckline. Now, it's not the cleanest pattern in the world. I will certainly give you that. However, if you start to think of that as an inverted head and shoulders, there's your neckline. Technically, we closed above on the Friday session. So I would start to say any acceptance here is a good thing, and then monitor for continuation, a break essentially of your resistance trend line for a move into these highs right here. To give you a number, that target would roughly be 25. So this one might need some time to firmly put in some confirmation, and then a break gets more interesting, but I do like the relative strength compared to what we've seen in almost everything today in the video. So that's going to wrap up our trade ideas. If you enjoyed today's video or learned anything new, let me know in the comments section or by giving the video a thumbs up. Don't forget our secondary channel is linked down below in the description, where we cover roughly 10 to 12 tickers every single day. That's not week, every single day. And with all of that being said, I wish you a green trading week.